Global financial markets are preparing to resume trading as a confluence of significant developments across precious metals, energy markets, and an active military conflict in the Middle East have unfolded over the course of the weekend. With the Chicago Mercantile Exchange scheduled to open in the hours ahead, market participants are closely examining a range of data points and geopolitical events that have accumulated since Friday's close across multiple asset classes, including silver, gold, oil, and risk assets broadly. Starting with silver, the Western spot price is currently reported at $84 per ounce. The Shanghai Exchange, however, is pricing physical silver at $96, representing a $12 gap between what the Western paper futures market reflects and what buyers in the East are paying for physical metal. That premium has moved in one consistent direction across recent sessions, with the sequence recorded at 13.5%, 13.8%, 13.7%, and 14.6% across consecutive trading days. COMEX's total silver inventory reached 349 million ounces as of Thursday, representing a decline of 2.22 million ounces in a single session. That figure extends a run of 9 consecutive weeks of net inventory declines. The weekly drain came in at 8.4 million ounces, equivalent to nearly 262 metric tons removed in a single week. Simultaneously, London Bullion Market Association silver inventory in London dropped 2.4% in February, with holdings now sitting at 870 million ounces. Both major Western vault systems are therefore reported to be losing metal at the same time. On the gold side, the Western spot price stands at $5,171 per ounce. PAX-G, the tokenized gold product that continues trading during periods when traditional exchanges are closed, is currently priced at $5,177, essentially flat from Friday's close. Kinesis silver is reported at $85.4, also closely aligned with where Western paper markets closed on Friday. These weekend token pricing signals are therefore not indicating a significant directional move in either metals market heading into tonight's open. On the energy front, oil is telling a markedly different story. On Hyperliquid, the decentralized futures platform that operates independently of the Chicago Mercantile Exchange schedule, United States oil is currently trading at $115 per barrel after reaching a high of $126. Brent crude is reported at $97 on the same platform. These figures come against the backdrop of active military operations in the Middle East that have directly affected oil infrastructure, shipping lanes, and regional water systems. With the key data points now established across silver, gold, and oil markets, our coverage continues with a detailed examination of the specific events that have unfolded this weekend. Turning now to the specific developments that have unfolded across the Middle East this weekend, the source report documents a series of military operations and infrastructure strikes that have directly affected energy production, water systems, and shipping routes across the region. The cumulative impact of these developments is being reflected in energy market pricing on platforms that remain active during the weekend period. United States and Israeli forces struck major oil infrastructure in Iran over the course of the weekend. The report describes oil spilling from depots into streets, entering drainage systems and catching fire, with walls of flame reported on Tehran's highways. Residents of Tehran woke on Sunday to a skyline described in the report as shrouded in black smoke and acid rain clouds. Iraq's oil production has collapsed by approximately 60%, as the ongoing conflict blocks tanker movement through critical maritime corridors. These developments form the primary backdrop against which energy markets are currently pricing supply risk. Beyond the strikes on oil infrastructure, the source report notes that United States and Israeli forces are reported to be planning to send special forces into Iran with the stated objective of seizing Iran's nuclear stockpile. That stockpile is reported to consist of approximately 450 kilograms of highly enriched uranium, described in the report as sufficient material for approximately 10 nuclear weapons. The report notes that if this operation proceeds, a ground incursion into Iranian territory would represent a stated operational objective rather than a contingency scenario, fundamentally altering the duration calculus of the current conflict. Iran struck a desalination plant in Bahrain during the weekend, a development the source report identifies as carrying significance beyond the immediate military context. The report provides the following data on regional water dependency. Kuwait draws 90% of its water supply from desalination infrastructure. Qatar draws nearly 100% of its water from desalination. The United Arab Emirates and Saudi Arabia both draw above 70% of their water supplies from desalination systems. The report states that when desalination infrastructure becomes a battlefield target, the escalation calculus for the entire region changes entirely. Iran's foreign minister issued a warning that attacking infrastructure carries grave consequences, a statement the report notes was followed by the strike on Bahrain's water supply infrastructure. The report characterizes this progression as a shift from missile exchanges and military-based strikes to infrastructure warfare conducted across the Gulf coastline, directly facing Iran across the Persian Gulf. The report states that once energy systems, water systems, and shipping lanes simultaneously become targets, the region transitions into a systemic risk zone, and that under those conditions, oil markets stop pricing conventional supply and demand dynamics and begin pricing geopolitical survival. Saudi Aramco recorded its largest single-session stock price surge since April of 2023 on Sunday. The source report identifies the developments underlying that move as more significant than the stock price movement itself. Aramco fields came under drone attack this weekend, with the report noting minor damage at the Abqaiq site. The Ras Tanura refinery, identified as Saudi Arabia's largest, was forced to halt operations following a strike the previous week. Saudi Aramco is reported to be rerouting shipments through Red Sea facilities on Saudi Arabia's west coast as an alternative to the Strait of Hormuz, with 8 supertankers already loaded this month, placing the company on pace for a record volume through that alternative route. Aramco also raised its April oil price for Asian buyers by the largest margin since August of 2022. The company's earnings release is scheduled for March 10th. The Strait of Hormuz remains the central pressure point in the current energy supply disruption. The source report notes that approximately 20% of global oil flows through that single passage under normal operating conditions. The report states that energy markets are currently pricing supply risk rather than a peace scenario, noting that mainstream media headlines are pushing a de-escalation narrative that energy market pricing is not corroborating. On the diplomatic and political front, the source report documents several statements from key parties that it characterizes as reflecting entrenchment rather than de-escalation. United States President Trump stated publicly that the war will continue for a little while, declined to project a timeline when asked, and when pressed further responded with the phrase, "whatever it takes." The report identifies these 3 words as a war economy message rather than a de-escalation signal. The report further notes that the United States has spent approximately $6 billion in the first week of the conflict, with $4 billion of that figure allocated to munitions, primarily missile interceptors. The report characterizes this spending rate as a data point about the expected duration of the conflict, rather than solely its intensity. Iran has selected a new supreme leader and will announce the name in the near term, according to the source report. Israel immediately stated publicly that it will target every new leader Iran appoints. Iran declared it is prepared for full-scale war. The report presents these statements as reflecting a posture of entrenchment on all sides, rather than movement toward resolution. South Korea is reported to be weighing an oil price cap for the first time since 1997, a measure the report notes was last considered during a period of comparable energy market stress. China's Foreign Minister Wang Yi, speaking at the National People's Congress session, stated that China stands ready to restore order, tranquility, and peace to the Middle East. The source report characterizes this statement as Beijing formally signaling strategic interest in the future architecture of the region at the precise moment that the existing regional architecture is under maximum stress. The report notes that Iran represents a key node in China's Belt and Road Infrastructure Initiative, and that Middle Eastern oil flows primarily eastward, framing China's public posture as calculated strategic positioning rather than a routine diplomatic statement. Turning now to conditions across broader financial markets. The source report documents significant capital movement away from risk assets over the course of the preceding week. More than $190 billion was wiped from the cryptocurrency market over a period of 3 days. Bitcoin declined by over 8% during that period, while Ethereum fell by nearly 10%. Those losses came on top of declines already recorded on Friday. Across traditional equity markets, the S&P 500, the Nasdaq, the Dow Jones Industrial Average, and the German DAX all closed lower. $900 billion was wiped from United States equities in a single session. The source report states that risk assets across the board are pricing a prolonged conflict. The source report then addresses developments in the private credit market, identifying 3 simultaneous episodes at major alternative asset management firms that it presents as a significant structural data point. BlackRock moved to limit withdrawals from its $26 billion HPS corporate lending fund after receiving $1.2 billion in withdrawal requests within a single quarter. The firm capped redemptions at 5% of the fund and blocked the remainder. Blackstone's $82 billion fund recorded its highest withdrawal request in the same week and was required to inject $400 million of its own capital to cover investor exits. At Blue Owl, investors withdrew 15.4% from one fund in January alone, forcing the firm to sell $1.4 billion in loans to fund the payouts. Blue Owl subsequently permanently halted traditional redemptions at that specific fund. The report notes that these 3 episodes, involving 3 of the largest alternative asset managers, occurred within the same time window, with all 3 firms encountering liquidity constraints simultaneously. The report references Howard Marks and his publication, Mastering the Market Cycle, citing the observation that market cycles turn at the point of maximum complacency when risks feel most remote. The report notes that illiquidity was not being priced as a risk 18 months prior to these developments, and that 3 funds blocking exits in the same week represents a notable shift in that dynamic. On the gold market, the source report highlights a significant divergence between paper and physical market behavior. The GLD exchange-traded fund recorded one of the largest weekly outflows in recent years, with $4.2 billion leaving the fund in a single week at prices near all-time highs. The report characterizes this as evidence of paper selling at scale. However, the physical gold price has not followed that selling pressure downward. Gold remains above $5,170 per ounce, despite that volume of paper selling hitting the market. The report identifies this divergence, in which record paper selling pressure has failed to move the physical price lower, as a structural signal about the underlying demand conditions supporting the physical gold market. The source report then presents what it explicitly identifies as the resistance case, stating its commitment to presenting both sides of the current market picture. Paper markets continue to dominate short-term price discovery. A ceasefire rumor, a spike in the US dollar index, or coordinated algorithmic selling can move silver prices lower rapidly, regardless of physical market tightness. The report specifically notes that physical tightness-involved inventory is not a factor that algorithmic trading programs running stop hunts are required to respect. The $115 oil reading on Hyperliquid is identified as a weekend directional signal rather than a guaranteed outcome when the Chicago Mercantile Exchange opens. The data calendar for the week ahead is identified in the source report as carrying particular significance in the current environment. The Consumer Price Index release is scheduled for Wednesday. Gross domestic product data, the Personal Consumption Expenditures Index, and the Job Openings and Labor Turnover Survey are all scheduled to report on Friday. The report notes that any one of those data releases landing outside of market expectations could provide paper sellers with a window to execute downward price pressure, regardless of the underlying physical market dynamics. The report specifically highlights the Consumer Price Index release as a particularly consequential data point, given that inflation data will be dropping into an active oil supply shock environment simultaneously. The source report also provides specific technical observations on the closing price action of both silver and gold on Friday. Silver closed at $84.6, having rejected the $85 level 3 times during that session, despite the US dollar trading lower on the day. The report identifies that triple rejection of the $85 level as a price action development worth monitoring. Gold closed at $5,170, with the report noting that this positions the metal toward tape reading objectives previously identified at $5,181 first, followed by $5,200. The report identifies gold as having demonstrated relative strength compared to silver during Friday's session, and notes that the Friday 8 o'clock in the morning lows remain the invalidation level for both metals heading into the new trading week. For independent verification of the figures presented in the source report, the following primary sources are identified. COMEX inventory reports are updated daily and are publicly available. London Bullion Market Association statistics are published on a monthly basis. The BlackRock fund filing referenced in the report is identified as available on Reuters, dated March 6th. The report directs readers to verify all data points through these primary sources, rather than relying on secondary reporting. As markets prepare to resume trading with the Chicago Mercantile Exchange scheduled to open this evening at 6 o'clock Eastern Time, the full scope of reported developments across precious metals, energy markets, geopolitical events, risk assets, and private credit conditions can now be consolidated into a final, comprehensive summary. On silver, the Western spot price stands at $84 per ounce, while Shanghai is pricing physical silver at $96, a $12 gap between Western paper market pricing and Eastern physical market pricing. COMEX total silver inventory is reported at 349 million ounces as of Thursday, reflecting a single-session decline of 2.22 million ounces and extending a run of 9 consecutive weeks of net inventory declines. The weekly drain totaled 8.4 million ounces, equivalent to nearly 262 metric tons. London Bullion Market Association silver inventory declined 2.4% in February, now sitting at 870 million ounces. Both major Western vault systems are therefore losing metal simultaneously. The Shanghai premium sequence across recent sessions, 13.5%, 13.8%, 13.7%, and 14.6%, has moved in one consistent direction across each consecutive trading day. Silver closed Friday's session at $84.6, rejecting the $85 level 3 times during that session, despite the US dollar trading lower on the day. Gold closed at $5,170, demonstrating relative strength compared to silver during Friday's trading. The Friday 8 o'clock in the morning lows are identified as the invalidation level for both metals. PAX-G weekend pricing is reported at $5,177, essentially flat from Friday's close. Kinesis silver is reported at $85.4, similarly aligned with Friday's Western paper close. Weekend token pricing is therefore not signaling a significant directional move in metals heading into tonight's open. On energy markets, United States oil on the hyperliquid decentralized futures platform is currently trading at $115 per barrel after reaching a weekend high of $126. Brent crude is reported at $97 on the same platform. These readings reflect a weekend period during which United States and Israeli forces struck major oil infrastructure in Iran. Iraq's oil production collapsed by approximately 60% due to tanker movement being blocked by the conflict, and Saudi Aramco's Ras Tanura refinery, the country's largest, was forced to halt operations. Aramco is rerouting shipments through Red Sea facilities on Saudi Arabia's west coast, with 8 supertankers already loaded this month, placing the company on pace for a record volume through that alternative route. Aramco raised its April oil price for Asian buyers by the largest margin since August of 2022, with earnings scheduled for release on March 10th. The Strait of Hormuz, through which approximately 20% of global oil flows under normal conditions, remains the central pressure point in the current supply disruption. Iran struck a desalination plant in Bahrain during the weekend, a development carrying particular regional significance given that Kuwait draws 90% of its water from desalination, Qatar draws nearly 100%, and the United Arab Emirates and Saudi Arabia both draw above 70% of their water supplies from desalination infrastructure. South Korea is reported to be weighing an oil price cap for the first time since 1997. On the geopolitical front, United States President Trump stated publicly that the war will continue for a little while, declined to provide a timeline, and responded to further questioning with the phrase, "whatever it takes." The United States has spent approximately $6 billion in the first week of the conflict, with $4 billion allocated to munitions consisting primarily of missile interceptors. Iran has selected a new supreme leader, with an announcement reported to be forthcoming. Israel stated it will target every new leader Iran appoints. Iran declared it is prepared for full-scale war. China's Foreign Minister Wang Yi, speaking at the National People's Congress session, stated that China stands ready to restore order, tranquility, and peace to the Middle East. On risk assets and private credit, more than $190 billion was removed from cryptocurrency markets over 3 days, with Bitcoin down over 8% and Ethereum down nearly 10%. $900 billion was wiped from United States equities in a single session. BlackRock limited withdrawals from its $26 billion HPS corporate lending fund after receiving $1.2 billion in withdrawal requests in a single quarter, capping redemptions at 5%. Blackstone's $82 billion fund recorded its highest withdrawal requests in the same week and injected $400 million of its own capital to cover exits. Blue Owl investors withdrew 15.4% from one fund in January, forcing the sale of $1.4 billion in loans and the permanent halting of traditional redemptions at that fund. On gold, the GLD exchange-traded fund recorded outflows of $4.2 billion in a single week at prices near all-time highs, while the physical gold price remained above $5,170 despite that volume of paper selling. The key data releases scheduled for the week ahead include the Consumer Price Index on Wednesday and Gross Domestic Product, Personal Consumption Expenditures, and the Job Openings and Labor Turnover Survey, all reporting on Friday. Primary sources for independent verification include daily COMEX inventory reports, monthly London Bullion Market Association statistics, and the BlackRock fund filing available on Reuters dated March 6th. This has been a comprehensive pre-market briefing covering silver and gold market structure, Eastern and Western pricing dynamics, energy supply disruptions, military operations and geopolitical developments across the Middle East, risk asset conditions, private credit fund liquidity developments, and the data calendar for the week ahead. All figures and developments reported are drawn exclusively from the original source material. Individuals are encouraged to verify all data points through the publicly available primary sources identified in this broadcast and to consult qualified financial professionals before making any decisions related to commodity markets or investment portfolios. We will continue to monitor all developments as trading resumes this evening. Thank you for watching.